Chapter 10 is what we're going to cover today. I think you're going to enjoy this, actually. I think it's after Chapter 9, it's downhill from here. Okay? Stockholders' equity section. Now, we have talked about stockholders' equity before, and we know there's a couple components to stockholders' equity. We know that the stockholders' equity section includes what we know as paid-in capital, which is like common stock. You know, that's what we're familiar with. When individuals own a piece of the company, they purchase stock in the company, and as a result, get to benefit in the dividends, the profits of the company. Another word for that is called paid-in capital. We're familiar with the common stock piece, but we're going to talk about some different kinds of stock in addition to common stock. Then we know there's another aspect or component of stockholders' equity called retained earnings. Those are the amount of earnings the company's kept or retained, which is the earnings not distributed in dividends to stockholders over the life of the company. Okay? So it's all the earnings since the beginning of the company minus any dividends that have been paid out. We're going to talk about something new today called treasury stock. Treasury stock is when the company purchases back its own stock that has been issued, but they're buying it back. We're going to talk about that. So here you see the paid-in capital, which in the past we've shown as common stock. Here's the section of retained earnings. The income made in the company since its inception minus what it's paid out in dividends. And then treasury stock is something new today. This is when a company purchases back that's already been issued stock. They purchase it back. So, paid-in capital, sorry, I'm going to turn this sucker off. Paid-in capital amount stockholders have invested in the corporation. Retained earnings, amount of earnings the corporation has retained. And then something new today, treasury stock, the corporation's own stock that it has reacquired. Here you see the stockholders' equity section of American Eagle. You see they have two types of stock. We're going to talk about preferred stock. They have in this case, they don't have any preferred stock. They only have common stock. This additional paid-in capital is that portion of the common stock that's over and above the par value, which we'll talk about today. Then they show the retained earnings. And then something new we're looking at is this treasury stock. Treasury stock with companies will always be a minus sign. It takes away from the stockholders' equity section. Okay? And we'll talk about that. But know that treasury stock is going to be a minus to the total stockholders' equity section. Invested capital. When we have a corporation, you own stock. People purchase a portion of the company by acquiring stock. When there's a corporation, the shareholders do not necessarily run the organization. As you see here, the stockholders who control the corporation or own the company vote for a board of directors. the board of directors are basically those individuals that the stockholders or the shareholders pick to elect a chief executive officer or the person who's ultimately going to run the company. It's the chief executive officer who controls the day-to-day activities of the company and who picks that management team that's under him or her. Okay? So know in this example, even though the stockholders own the company, they don't run the company. They elect a board of directors who determine who the CEO is going to be to run the company. Okay? Like you see here, the corporation stockholders ultimately control the company. The board of directors appoints the CEO, and ultimately the CEO with his staff run the company. Now, when a corporation starts, usually the individuals who invest in a corporation are the founders of the business. And oftentimes to get the business up and running, they get investments by friends and family to help expand the company. Oftentimes, they can find what they call angel investors or venture capitalist firms to help provide the capital they need to expand. Ultimately, the greatest way of expanding is going public, to where your shares are public with where they're able to be purchased and sold on the stock exchange. There is a company here in town. Have any of you guys heard of Indeed Brewery? Let me see if I can find it. So this is kind of a fun story. Indeed Brewing Company is down off of 15th Street in Minneapolis. And I know the individual who started this company. He's actually a client of mine. And he started this brewery probably 10 years ago. And he's involved with two other individuals who are running, in the day-to-day activities of the company. And they only had so much money. I mean, these are young people they had a vision and they have a passion and they wanted to get this up and running. So they put in what they could, and then they went to their family members and they had all their family members purchase shares in the company. Now, they've really done an amazing job. They've expanded into Milwaukee because breweries are very unique. You have to have a physical presence wherever you want to be able to, the word isn't license the beer, but if you want to sell the beer in that state, you have to have a brewery in that state. So if you would go to a lot of the local restaurants, they'll have Indeed, their Indeed brands. And then you go to liquor stores, they have Indeed. To be able to do that in other states, they have to have that presence in the state. So now they're in Milwaukee. It's really cool, guys, to see these young people with a vision really make it work. But you need money to grow, to expand, to open up a whole nother location. It costs. So right now, I think they've expanded as much as they're able to based on the ability for them to raise capital. Does that make sense? And it just depends on what what the vision is. To grow, you need money. And to get money, sometimes the best way that companies get that is by going public. Now, there's some real benefits, but as we're going to talk about, there's some real drawbacks. But I just kind of wanted to give you an example of a company that, they're doing amazing. It's kind of fun to see you go into an establishment, and they're able to sell this Indeed, but that didn't happen overnight, and it doesn't happen without money. Unfortunately, you need money to grow. So, in their case, they are at step 2. They're kind of looking to possibly get another outside investor, but that's where they're at right now. Other companies continue on to going public. Corporations first raise money from the founders of the business, friends, and family. But then to really grow, companies have to get money from either angel investors, venture capital firms, or an IPO. Now, whenever this happens, though, it's a trade-off because they then own a piece of the company and sometimes want to say. Okay? Most companies are private corporations. The public corporations we know of are the big ones. Here, this allows for public investment. You have more stockholders. The negative with that is they're regulated by the Securities and Exchange Commission, which has a lot of parameters, which they need to, because the public can invest in it. But there's a lot more paperwork and cost. Examples of public: Walmart, Microsoft, Intel, Apple, you name it, they're out there. Now, private corporations cannot have a public investment. There are many fewer shareholders, but they're not regulated by the Securities and Exchange Commission because the stock is not public. Some examples of private companies: Cargill, Coke Refinery, Coke Industries, oil and gas, Mars Food and Candy. So there are some really big companies that are private companies, but they've got some money behind them. Now, when you're a stockholder or a shareholder, I use those terms synonymously. You have certain rights. You have the right to vote. You can vote on matters such as the election of corporate directors. You have the right to receive dividends if they're going to give you dividends. And you have a right to share in the distribution of assets if a company gets dissolved. Now, that's after the creditors get paid off. The advantages of a corporation, and please know there are many advantages, but a shareholder has what's called limited liability. The only amount a shareholder can lose is what they've invested in the company. They can't come back after more money. Whereas when you're a sole proprietor, it's called you have unlimited liability. Because you are the only individual involved in that organization. And if someone's harmed from you, it's called unlimited liability. They can come back after your own personal assets if you've in fact harmed them. Now, advantages of a corporation: the ability to raise capital and transfer ownership is huge. But there's usually additional taxes and a heck of a lot more paperwork. And everybody's got to weigh it out. But I would tell you that the advantages are significantly more. Note that the primary advantages of the corporate form of business are limited liability first and foremost, and then the ability to raise capital. So guys, which of the following is a primary advantage of forming a corporation? Increased ability to raise capital and transfer the ownership. Excellent. Now, we've kind of talked a little bit about common stock, but we're going to go into a lot more detail today in how we record the issuance of common stock. Know that when a company becomes a corporation, it's at that time that you determine how many shares the company has the ability of securing for that company. So I'm not an attorney, but oftentimes I have clients that need to create a corporation, and if it's just a single member, I do that for them. And it's at that time with the state of Minnesota, I determine they have up to 100,000 shares, or whatever the amount is we want to say, that they have the ability to issue during their lifetime. So I guess you would call that authorized stock. We authorize the corporation to be able to issue 100,000 shares. So all the amount of stock is the authorized amount at the initial startup of the corporation. There may be stock that's been unissued. It's not been ever issued. There's outstanding stock, that which individuals have shares of. And then there's treasury stock. Now this section here, the outstanding and the treasury stock, is issued stock. The treasury stock was issued and it's been repurchased or purchased by the corporation. Okay? So know that all stock is authorized, and the authorized stock can be issued or unissued. And out of the issued stock, it can be outstanding or it can be treasury stock. No, authorized are the shares that are available to sell. Issued are the shares that have actually been sold, which includes the treasury stock. And outstanding are the shares held by investors. That excludes treasury stock. Okay? Just know this. So on your quiz, if you have a question like this, you know the right answer. Okay? That's where sometimes these PowerPoints are really helpful for you. Okay? Authorized equals issued plus unissued shares. Now, par value, quite honestly, is just a value or legal capital per share of stock that's assigned when the corporation is first established. Par value means nothing, basically. Par value has no relationship to the market value of the common stock. And many companies don't even have a par value on their stock. Generally, if they have a par value, it might be 0.000000001 cent. Okay? And many don't even have a par value. Students can confuse par value with market value. Par value is the legal capital per share that is set when the corporation is first established and has nothing to do with value. The market value per share is equal to the current share price. In most cases, the market value per share is going to be big, way bigger than any par value will ever be. Okay? So let's just say Canadian Falcon issues 1,000 shares of no par common stock at $30 per share. So when a company has a no par stock, the way we record that is a debit to the cash that comes in, and all of it gets credited to common stock. It's really straightforward and simple. If a company has par value on their stock, so let's say Canadian Falcon issues 1,000 shares of 1 cent par value common stock at $30 a share. We have to do it a little different. We debit our cash. We credit common stock for just the par value piece. So the 1 cent times 1,000 shares is $10. So the only piece that goes into the common stock is the par value. And then everything else above and beyond that par value is credited to additional paid-in capital. Okay? So guys, know we handle stock without a par value very different from what we do when there's a company that has par value. When there's a par value, the only portion that goes into common stock is the par value piece, the 1 cent times 1,000 shares. And everything else above and beyond that is credited to additional paid-in capital. Okay? Both common stock and additional paid-in capital are stockholder equity accounts. We just account for it a little different based on par versus no par. So guys, if Company A issues 20,000 shares of $5 par common stock at $12.50 per share, the entry to record the issuance would include which of the following? What do you think? You think C? Okay. C? Excellent. Cash is $250,000. 20,000 shares at $12.50. We'll debit cash for $250. We'll credit common stock for just the par value, 20,000 shares at $5 a share. And the entire rest, 150,000, will be credited to additional paid-in capital. Does that make sense, guys? So know that with common stock, depending on if it's par value or no par value, we handle it different. Now, there is another type of stock called preferred stock. We don't hear of it a lot. Not all companies have preferred stock, but it's called preferred stock because it's, quote, preferred over common stock in two facets. Preferred stockholders usually have the first rights to specified dividends. If the board of directors declares dividends, preferred shareholders will receive their designated amount of dividends before any common shareholders will. And in the event a company dissolves, the preferred shareholders have first dibs in the distribution of the assets over the common shareholders. Now, let's just be real blunt, though. My former husband was a pilot, And back in the 80s, he got on with this company called Emerald Air. And one day, he called me. He says, Nancy, my paycheck bounced. Not a good sign, is it? So the company was hurting. Needless to say, we didn't even get some paychecks. So any shareholders aren't going to get any money if the paychecks are bouncing. My point being, if companies are hurting and if they're going to be dissolving, chances are not even the creditors are going to get their money. Make sense? So for preferred stock, let's just say Canadian Bacon issues Canadian Bacon. Do I sound hungry? Canadian Falcon issues 1,000 shares of $30 par value preferred stock for $40 per share. So again, we're going to take for cash 1,000 shares at $40. It's 40,000. We credit the preferred stock 1,000 shares times the par value, 30,000. And then that additional above and beyond the par value, we credit to additional paid-in capital. As you see here, for Canadian Falcon, you see in the stockholders' equity section how they break down. They separate out the preferred stock from the common stock. So the preferred stock at par value is put here as an entry to preferred stock. The common stock at par value is put here. And then for both, everything issued above and beyond the par value gets combined into this additional paid-in capital. Okay? No, there are some features that may be available for preferred stock. It can be convertible. Some preferred stock can be convertible, which means exchanged for common stock. It can be redeemable. Shares can be returned to the corporation at a fixed price. And it can be what's called cumulative, where the preferred stock receives priority for future dividends if dividends are not paid in a given year. And we'll talk about that in just a minute. So, in terms of common stock versus preferred stock, common stock is going to have the biggest risk, but it's also going to have the biggest reward. Common stock, you get to vote, like we talked about earlier. The risk is high, but the reward is high. With preferred stock, you generally don't get to vote. And the risk is middle of the line, which is more of a safe investment, but the reward is also middle of the line. When companies issue bonds, like we talked about last week, for 2 weeks, bonds are a form of debt where they seek individuals to help finance. We know that stock is an equity component where they own a piece of the company. So bonds are a way in which companies can finance expansion, and those bondholders have absolutely no voting rights. They don't own a piece of the company. It's a very low risk, but the reward is just low too. It's an interest rate. Okay? Now, when we talk about preferred stock being what's called cumulative, what that means, guys, is let's just take this example where there's a company, they issued 1,000 shares of 8%, $30 par value preferred stock, and 1,000 shares of $1 par value common stock at the beginning of 2023, and no dividends were paid in 23 or 2024. If the company declares a dividend of $10,000 in 2025, how would the dividend be allocated between preferred shareholders and common shareholders? If the preferred stock is called cumulative, what that means is they are going to get a dividend every year. But if the company doesn't authorize a dividend, it just gets deferred until they finally do authorize a dividend. So in this case, when this preferred stock is called cumulative, the 8% $30 par value means that $2,400 of preferred dividends in 23 and $2,400 of preferred dividends in 24 are going to get paid first in 25. Okay? Then they're going to pay the 2025 dividends for the preferred shareholders. What's ever left over then goes to common shareholders. So this cumulative component is an amazing feature if it's there, if it's available. So out of $10,000, the common shareholders are only going to get $2,800 of it. Because of the cumulative component, the preferred shareholders get paid on 2023 and 2024 in 2025. Does that make sense, guys? Yes? No? Now, if it's non-cumulative, well, what that means is if they didn't authorize any dividends that year, it's just gone. So if a non-cumulative shareholder in 23 and 24, they didn't pay out any dividends, it's just gone. No one's going to get dividends. So then in 2025, when they are giving a $10,000 dividend, the preferred shareholders will get their guaranteed dividend, the 8% at $30 par, which is $2,400, okay? And then the rest goes to the common shareholder. Make sense? So remember, guys, there's a difference in who gets paid based on if we do cumulative versus non-cumulative. I think I already put that on here. So again, no, there's a difference. If it's cumulative, the breakdown shows pretty much most of it goes to the preferred shareholders, apart from $2,800 goes to the common stockholders. If it's non-cumulative, then the preferred shareholders will get their piece, the 8% of the $30 par, or $2,400, and the rest then goes to the common shareholders. Remember, preferred stock has preference over common stock in receiving dividends and in the distribution of assets in the event the corporation is dissolved. We record the issuance of preferred stock similar to the way we did for the issuance of common stock. Some preferred stocks cumulative, meaning any dividends not declared in a given year, accumulate to be paid in a later year. So let's look at Nathan's Athletic Apparel. We've got 2,000 shares of 5%, $100 par value preferred stock. The company issued at the beginning of 2023. All remaining shares are common stock. The company was not able to pay dividends in 2023, but plans to pay dividends of $22,000 in 2024. So assume the preferred stock is cumulative. How much of the $22,000 dividend will be paid to preferred stockholders, and how much will be paid to common stockholders in 2024? So 5% of $100 par value, 2,000 shares, if it's cumulative, the $10,000 in arrears from 2023, they'll get. The $10,000 for 2024, they'll get. And then the remaining will go to the common shareholders, which is $2,000. Okay? If it's non-cumulative, 2023 is done. It's a non-issue. It's a non-event. 2024, they'll get $10,000. And the rest goes to the common shareholders. Does that make sense? Yes? No? Guys, which of the following is primary advantage of owning preferred stock? C. Okay, now treasury stock. Treasury stock is when the company purchases its own stock. Issuing shares increases stockholders' equity, but buying back those shares decreases stockholders' equity. Rather than reducing the stock accounts directly, though, we record treasury stock as a separate contra account. Remember I said it's a negative number? Okay? Sometimes students confuse the purchase of treasury stock with investments in another company. Remember, equity investments would be the purchase of stock in another company, which is an asset. We would increase the asset. Treasury stock is the purchase of a corporation's own stock, and we record it as a reduction in stockholders' equity. It's not an asset because a company cannot invest in itself. Okay? When Canadian Falcon repurchases 100 shares of its own 1 cent par value common stock at $30 per share, we will debit the entire amount to treasury stock and we credit our cash. Okay? So we don't worry about additional paid-in capital or any of that when we purchase our own stock. It all goes straight to treasury stock. But here's the catch. Okay, this is showing you, guys, this is showing you before we issued or paid the purchased the stock, we were sitting at $100,000 in total stockholders' equity. Once we purchased the treasury stock, do you see how our stockholders' equity account is now sitting at $97,000? It's a minus. It's a contra account. It offsets our stockholders' equity. Here's the catch, though, guys. Remember we purchased it for $30? Canadian resells the 100 shares of treasury stock for $35. Remember, you've got to remember what they were purchased for. if we do that, we're going to debit our cash for the whole amount. We're going to credit the treasury stock for what we had purchased it for. And the rest goes into additional paid-in capital. Okay? So it's really important you remember what that treasury stock was purchased for, because we want to offset that treasury stock by that exact amount. And then if it's more than that, we'll credit additional paid-in capital. And if it's less than that, we'll debit additional paid-in capital. When we resell the treasury shares at $35, we must reduce the treasury stock account at the same $30 per share. Any extra gets put into additional paid-in capital. So now we were at $97,000. Once we reissue that treasury stock, do you see our treasury shares are now at 0? And our additional paid-in capital now is at $40,490. Okay. But guys, what happens if instead of reselling it for $35, we resell it for $25? So our cash is going to be our 100 shares at $25. But we still need to credit our treasury stock for the whole $30 because we need to get rid of it, get it off our books. We've reissued it. But in this case, do you see how we're debiting additional paid-in capital for $500? Because we want to get rid of that treasury stock. We don't have it anymore. Okay? And since we sold it for less than what we bought it for, we need to zero it out at $30, but then we're going to debit our additional paid-in capital. Any questions on this? Does it make sense? Remember, we include treasury stock in the stockholders' equity section of the balance sheet as a reduction in stockholders' equity. When we resell treasury stock, the amount of the sale price above or below the stock's original purchase cost is reported as an increase or decrease in additional paid-in capital. Why do they do this? Why do they go and buy their own stock back? Well, there's a couple reasons. If their stock is maybe underpriced, sometimes they'll buy it back just so there's less out there. And ultimately, hopefully, the goal is to increase its value. Sometimes, a lot of times, they do that because they don't want to pay out dividends. Yet, corporations have to do something with that cash because there's certain guidelines. If there's undistributed accumulated adjustments accounts, they need to do something with it. And so oftentimes, when they have extra money sitting around, they'll buy back their own stock in lieu of having to pay out dividends. And if you think about it, by buying back their own stock, they don't give themselves dividends. Since they're not outstanding stock there, it will increase the value of the earnings per share. Because there's less stock outstanding, therefore, the earnings per share is going to increase. Sometimes they need stock to satisfy employees that may have some employee stock options or ownership plans. So remember, when we purchase treasury stock, it's a contra account. It will be a negative effect on the shareholders' equity section. Okay, guys, let's look at this problem here. Finishing Touches has two classes of stock authorized: 8% $10 par preferred and $1 par value common. The following transactions affect stockholders' equity during 2023, its first year of operations. On January 2nd, we issued 100,000 shares of common stock for $35 per share. On February 6th, we issued 3,000 shares of 8% preferred stock for $11 per share. And on September 10th, we repurchased 11,000 shares of its own common stock for $40 per share. Then December 15th, we reissued that 5,500 of those 11,000 shares at $45 per share. So, the first one, January 2nd, issues 100,000 shares of common stock for $35 per share. So we see the par value's at $1, right? We're issuing it for $35 per share. We'll debit our cash for the whole amount. We credit our common stock for the par value, 100,000, and we credit our additional paid-in capital for the rest. Okay? On February 6th, we issued 3,000 shares of 8% preferred stock for $11 per share. But what's our par, guys? 10? See, it's 10? So we'll debit our cash for the full amount. We credit our preferred stock for the 3,000 shares at $10 a share, the par value, and we credit additional paid-in capital for the difference. When we repurchase our own stock at $40 a share, it all goes into treasury stock, doesn't it? The whole $40 a share is debited to treasury stock. We credit our cash. But when we reissued 5,500 of those shares, we want to make sure we zero out the treasury stock for those 5,500 shares. So even though we reissued them for $45, we need to make sure we credit out the treasury stock at the $40 a share. So the 5,500 shares at $40 a share, the 220,000 here, and the difference will go to additional paid-in capital. In this case, we're crediting additional paid-in capital. But if we reissue it for less than what we had purchased it for, we might debit additional paid-in capital. Correct? Treasury stock has a normal what? A? B? B. Now, when we pay dividends, that's part of the retained earnings section. Retained earnings are all the earnings retained in the corporation and those that have not been paid out as dividends. It should equal all net income minus all dividends since the company began. It will have a normal credit balance. If it has a debit balance, that means it's in the hole. A debit balance in retained earnings is a deficit. So let's say in year one, it has a deficit of $1,000. So in year one, we have a debit balance, and we're in the hole, $1,000. In year two, though, we made a profit of $3,000. Don't you see that the debit of 1,000 plus the profit of 3,000, the credit of 3, nets out retained earnings of 2,000? Yes? Then in year three, if we made 4,000 but we paid in dividends of 1,000, so 4 minus 1 is 3, we'd add that 3 to the previous 2,000 balance to get 5? Yes? No? In year 4, we made a profit of 10,000, but we paid dividends out of 3. So we have a net here of 7. That 7 to this 5 would bring us a balance of 12. Does that make sense? The key here is that you understand when it's a negative, it's a debit balance to retained earnings. You know how retained earnings normally has a credit balance? In that case, if it's a minus, it's a debit balance. The balance of retained earnings equals all net income minus all dividends over the life of the company. When we pay out dividends, we usually pay them in the form of cash. They're distributions by a corporation to its stockholders. Not all companies pay dividends. Growth companies usually reinvest their earnings because they need it to grow. Look at this with Facebook. We have never declared or paid cash dividends on our capital stock. We currently intend to retain any future earnings to finance the operation and expansion of our business. And we do not expect to declare or pay any cash dividends in the foreseeable future. As a result, you may only receive a return on your investment in our Class A common stock, and if issued, our Class C capital stock if the trading price of your shares increase, which is usually how you make your money on stock. The price increases. When we're dealing with dividends, there's some dates to be aware of. The declaration date, the record date, and the payment date. The declaration date is just the day they say, hey, we're paying dividends. The record date's the date on which the company looks at its records to determine who are the stockholders and who's getting the dividends. And then the payment date's the date the actual distribution happens. So, on March 15th, Canadian Falcon declares a 25-cent per share dividend on its 2,000 outstanding shares. So at that declaration date, they debit our dividends and credit dividends payable. The record date, we're not going to record anything. The record date just means, hey, it's on that date those people are getting the dividends. People who are shareholders on that date get the dividends. But when it's paid on April 15th, it's then we debit our dividends payable and we credit our cash. Okay? Remember, guys, The declaration of cash dividends will decrease retained earnings because we debit our dividends, which is a reduction of retained earnings, and it increases the liability account, dividends payable. Then when we actually pay the dividends, it decreases the liability and it decreases the cash, the asset. Okay? So guys, on which date would a company record a debit to dividends and a credit to dividends payable? Date of declaration. So, I did that, okay. I doubled that, sorry. Let's look at Italian Stallion. Has the following transactions during the year related to stockholders' equity. February 1st, issues 6,000 shares of no par common stock for $16 a share. Easier. Remember, it all gets credited to what? Common stock. May 15th, issues 700 shares of $10 par value preferred stock for $13 a share. October 1st, declares a cash dividend of $1.25 per share to all stockholders of record. On October 15th. October 15th is the date of record, which we don't have a journal entry then. And then October 31st pays the cash dividend. I'm going to give you about 5 minutes to attempt these. We're going to go over them, okay? And I will be right back. Is that okay? Okay, guys, so the first journal entry issues 6,000 shares of no par common stock at $16 a share. Debit or cash, all of it gets credited to common stock. When we issued our preferred stock, 700 shares of $10 par value preferred stock at $13 a share, we debit our cash, we credit the preferred stock for the par value, and we credit our additional paid-in capital. When we declare dividends, we debit our dividends, credit our payable. On the record date, there's nothing we do. And the date we pay them, it's at that time we debit our payable and we credit our cash. Does that make sense, guys? It's pretty straightforward. Okay. Now, there's also something they do called stock dividends and stock splits. Stock dividends or stock splits are just additional shares of stock distributed by corporations to stockholders rather than cash. Large stock dividends, 25% or more of the shares outstanding, and stock splits are declared primarily due to the effect they have on stock prices. So let's just say you own 100 shares of stock and they're going to give you a 10% stock dividend. What that means is you're going to get an additional 10 shares. If it's a 20% stock dividend, that means you're going to get 20 more shares. And if it's a 100% stock dividend, then you're going to get 100 additional shares. A split is a large stock dividend that includes a reduction in the par or stated value per share. So if a company declares a stock split, we do not record a transaction then. When they declare a stock split, in this case, Canadian Falcon declares a 2-for-1 stock split on its 1,000 shares of 1 cent par value common stock. The balance in the common stock account is 1,000 shares times 1 cent, or $10. When they declare a stock split, we don't even record a journal entry. The balance is going to stay at $10. But since we're doubling our stock, the par value then gets reduced to 0.005 cents. Instead of 1 cent, because we've doubled our shares, all it's going to do is change the par value now to 0.005 cents. Okay? When we have a dividend, though, we are going to record a journal entry. When we have a dividend, we're going to debit our stock dividend, and remember, dividends reduce retained earnings, don't they? And they increase our common stock. So any type of dividend reduces retained earnings, increases our stock section of the stock statement of stockholders' equity. So if we show a stock dividend, we'll debit our stock dividends and we credit our common stock. Large stock dividends record a decrease in retained earnings and an increase in common stock recorded at par value. So here you see, if we've got before our 100% stock dividend, this isn't a stock split, a stock dividend, we see our common stock is at 10, our retained earnings is at 29,500. When we record a stock dividend, even though it's a 2-for-1 stock split, we're recording it as a dividend, it's telling us. Then we'll debit our common stock. So now instead of 10, it's now 20, and our retained earnings has been reduced by 10. So no, when there's a stock split, we don't do a journal entry. We just know the par value is going to decrease. But when we do a stock dividend, ultimately, the total of stockholders' equity isn't going to change, but it's going to increase common stock and decrease our retained earnings. But it's still going to, overall, the stockholders' equity section stays the same. Make sense? Small stock dividends get recorded at market value, not par value. We don't change total assets, total liabilities, or stockholders' equity. We decrease one equity account, retained earnings, and it increases the common stock and the additional paid-in capital. So when we've got a small stock dividend, we will debit our dividend and we will credit, in this case, common stock at par value and our additional paid-in capital. Guys, what do you think here? A company has 1,000 shares of $20 par stock outstanding and issues a 2-for-1 split. How many shares are outstanding after the split? What do you think? If we had 1,000 shares and they're issuing a 2-for-1, now we have 2,000 shares, right? Stock dividends and stock splits. Oh, well, I have these doubled. I'm so sorry about that. Think of it this way, guys. When you declare a stock dividend and a stock split, it's like cutting a pizza into more slices. Everyone has more shares, but each share is worth proportionately less than before. It's only one size pizza. We can make that pizza 5 slices or we can make it 15 slices. Make sense? You can say you ate 10 slices versus 2 slices, but it's the same amount. Okay? So guys, on September 1st, when the Board of Directors of Colorado Outfitters declares a stock dividend on its 10,000 $1 par common shares, the market price of the common stock is $30. Record a stock dividend assuming a small 10% stock dividend, 100% stock dividend, or a 2-for-1 stock split. So if we're doing a 10% stock dividend, we record this at market value. We show 10,000 times 10% at $30. That $30,000 is a debit to your dividend, which ultimately is retained earnings. And we credit our common stock for the par value. We credit our additional paid-in capital for the difference. That's for a small stock dividend. For 100% stock dividend, we're just going to debit our stock dividends and credit our common stock. And for a stock split, we do nothing. Remember, you don't record a journal entry. It's just the, nothing changes apart from the par value. So a company has 1,000 shares. Oh, I already did that one. Sorry, guys. No, the stockholders' equity section is part of the balance sheet. Remember, it's a snapshot in time. The statement of stockholders' equity isn't a snapshot in time. It shows you the summary of what happened throughout the period. So here, the statement of stockholders, the stockholders' equity section of the balance sheet as of December 31st, 2023, shows exactly where it was as of that date, at the end of that day. The statement of stockholders' equity shows what occurred during the entire year. What was issued, what was repurchased, what was paid in dividends, cash dividends, stock dividends, you name it, throughout the entire year. Okay. United Apparel has the following balances in its stockholders' equity account on December 31st. Treasury stock is $850,000. Common stock is $600,000. Preferred stock is $3,600,000. Retained earnings $2,200,000, and additional paid-in capital $8,800,000. It gave us various accounts, and we need to prepare the stockholders' equity section of the balance sheet. So you see here, we would show our preferred stock, our common stock, our additional paid-in capital for the total paid-in capital, then our retained earnings, then our treasury stock. But guys, do you see the key here? Treasury stock is a contra account. It is a minus. So our true stockholders' equity here is $14,350,000. Don't forget that if a quiz asks you to do this. Okay? You don't add treasury stock, do you? You subtract it. Okay? I'm going to let you go through the various ratios on your own. Any other questions, guys? Okay.